Risk management. This is what is going to determine your success as a day trader. It's not how well you can analyze charts or how many winning trades you can make. It's all about controlling your risk. Risk should be your number one focus, not the reward. On every single trade you make, you need to think about how much you can lose first, not how much you can gain. When I first got into trading, all I thought about was the reward. I was constantly thinking about the possibilities of how much money I could make. I would say things like, this setup looks really good, and if I'm right, I can make $2,000. Or if I would have gotten into this trade before it jumped 100%, I could have doubled my money. Or I would say things like, man, if I just would have sold sooner, my winning trade wouldn't have turned into a losing trade. I was always concentrating on winning and making big money, but instead, my losers were the ones that were being big, not my winners. This is a very common problem with day traders. Their losers are bigger than their winners, which cause them to be unprofitable. It does not matter if you have a 90% win rate if your winners average out to be $10, but your losers average out to be $100. You're still a losing trader. So by putting the focus more on risk rather than the reward, you will make your winners bigger than your losers. Successful day traders all have one thing in common. They are good at being losers. I hear some traders say, the loss isn't real until you sell. That is the logic that has traders hold on to their losers too long, hoping that their loss will turn around to a winner, but only to watch their loss get bigger and bigger and bigger because they didn't want to lose in the first place. No one wants to lose money. It's a horrible feeling, which is why selling a loser is a lot harder than you think, because once you have sold the loser, the loss becomes real. Also, it can be really frustrating to sell at a loss only to see minutes later that the stock turned around and you could have profited. The reality is that selling a small loser, no matter what, is no big deal. The quicker we sell that loser, the faster we can move on to the next trade with a clear head and make our money back. If we let our losers get too big, rational thinking starts to diminish, and we start acting more on emotions. We may get frustrated and add to a losing position, or may try to revenge trade after a big loss, or take on more risk by trading with larger size on the next trade to try to make everything back. These are huge mistakes that can wipe out an entire account. It took me a long time to get used to cutting losses quickly because I never wanted to lose. I held my losers longer than I should have, which caused some unnecessary big losses. It took time to practice, but you have to be good at losing by accepting the fact that you were wrong on the trade. Every trade should have a fixed max loss per trade, and every day should have a fixed max loss per day. On every trade I take, I have a predetermined max loss on that trade just in case if I'm wrong. And this amount is always constant. My max loss on every trade is $100. It's not $100 on one trade and $300 on another. It's always $100. Your max loss should be something you are very comfortable with losing. By defining your max loss before making the trade, it will make it much easier to take the loss if you are wrong because you've already accepted the amount you're risking. If you don't define this max loss before entering a trade and the trade goes sharply against you, you may not accept the loss, and it may cause you to hesitate to cut it shortly. It may cause you to make detrimental mistakes such as holding on to an increasing losing position or averaging into a losing trade. Now, I could be wrong on every single trade I make on a particular day, which can get really frustrating because it has happened before. Losing does not feel good, and I know that if I'm losing, I am not in the best mindset to keep trading. So in case this happens, I have a max loss per day. I have a setting through my broker that prohibits me from trading if I am down more than $400 in one day. This forces me to call it quits and then come back fresh the next day. Having a max loss per trade and a max loss per day is going to force you to keep losses small. It's also going to keep you from revenge trading or taking on more risk by trying to dig yourself out of the hole. Now, here's a quote I found by Bernard Baruch, which is something I cannot agree more with. It's not about how much you make, but how much you don't lose. That is the mindset you need going into each and every trade. Focus on the risk, not the reward. There is no trading strategy that produces over 100% wins. In fact, being right over 75% of the time is pretty difficult. I'm usually only right 50% of the time, and I'd say that the majority of other traders are too. So accepting the fact that you will be wrong almost half of the time is why this concept of risk-reward ratios is extremely important. On every trade you make, your profit target should be at least the same amount as your max loss per trade. If I was risking $100, I would want to start taking profit once I'm up $100. This is what we call having a risk to reward ratio of 1 to 1. Your risk is the same amount as your reward. Having a risk to reward ratio of 1 to 1 allows you to be right 50% of the time and still break even. Now, unless your win rate is higher than 50%, then you won't make money using a 1 to 1 risk to reward ratio all the time. My win rate is around 50%, so I need to always aim to try to get a risk to reward ratio of 1 to 2 or higher. So on every trade, I risk $100 to try to make $200 or higher. This is how I'm able to make money being right only 50% of the time. And for me to just break even, I just need to be right 33% of the time. The bottom part of this graph, this green area right here, is a positive risk to reward ratio. This is where we want to be because it allows us to have more losers and still be profitable. Staying in this area is more forgiving, and it can also take away a lot of stress in trading. You want to be in this area because you will make mistakes that cause you to make losing trades. We are human and mistakes happen from time to time. Even the best traders in the world give in to FOMO or break their trading rules or give in to fear from time to time. So by allowing yourself to have room for error by not needing to be right on every trade will help you stay profitable. The top portion of this chart is a negative risk to reward ratio. This is where trading can get really stressful because you have to maintain a high win rate just to break even. Having that pressure to have to win on every single trade can lead you to make mistakes such as holding losers too long or not accepting the loss or adding to losing positions or revenge trading and so on. Stop losses are what we're going to use to protect ourselves from a losing trade getting out of hand. A stop loss is the certain price where the trader sells for a loss when reached. This is the price at which you sell once your max loss per trade is reached. Each trade should have a stop loss placed around recent support or resistance. So that means you need to be buying and selling around support and resistance. This is going to be what keeps you from getting stopped out all the time. The best place to put stop losses when taking a long position is underneath strong support levels, because if a strong support level breaks and the price drops lower, that is when a long position does not make sense anymore. If you were taking a short position, you would place your stop loss just above resistance, because if resistance breaks and the stock price pushes higher, a short position would no longer make sense. I found that only buying around support and selling around resistance is the easiest and most predictable way to trade. Your share size should be based on the distance between your stop loss price and your entry price while keeping in line with your max loss per trade. Before I enter a trade, I go through a 4-step process in order. First, I determine my exact amount I'm willing to risk. Next, I determine where my stop loss should be. Then I determine where my entry price will likely be. Finally, I'll calculate the number of shares I need to take to abide by my max loss per trade amount. That may sound confusing, so here's an example. Let's say that we see a stock coming into a support level of $10. We're predicting a bounce off of the support level. So before going into the trade, I need to determine 4 things. What's my max loss that I'm willing to risk on this trade? I want to risk $100, so that's already predetermined. Next, I need to determine my stop price. Well, a good place to put a stop is right below a strong support level. We see that support is at $10. We're going to make our stop price at $9.90 to kind of give some room just in case if maybe the stock drops 5 or 6, 7 cents below support. So we want to give about a 10-cent stop below support. Next, we need to determine where's our entry price likely going to be. Well, we don't want to set a limit order or place an order right at $10. We want to wait for confirmation that the stock will maybe bounce off of the level. So we get the bounce, and then we're most likely going to buy this thing around 10.10, which would give us confirmation. So what is our difference between our stop and our entry price? It's 20 cents. So that is putting us at 20 cents at risk. If we want to abide by our max loss, if we were wrong on this trade, how many shares do we need to take? We would take 500 shares. So here's the math of doing this. If we're risking $100, how far away is our stop from our entry? So our stop is already predetermined. We said our stop is at 990. What's our entry likely going to be? Entry is going to be 1010. That's 20 cents. So we're risking 20 cents. Is the reward of 40 cents likely based off of technical analysis? Now, you have to look at the chart. You have to kind of determine, is 40 cents likely? Because we want 40 cents because this is going to be double our risk. Depending on what the chart looks like, if there's resistance above that's maybe a dollar away, then 40 cents will be likely. But if there's resistance maybe 10 cents away, we don't want to take that trade. We want to make sure that the reward is definitely obtainable and it's double what we're risking. So if that's the case, then we'll take the trade, and then we have to do some division to figure out our shares. So what we're going to do is take the dollars at risk. So we're risking 100. We divide that by the cents at risk, 20 cents, the difference between our stop and our entry. That will equal our share size. So in this case, it equals 500 shares. Now, this may seem confusing and it takes a long time to figure out, or you may need a calculator, but the more times you do this, you'll find that you'll use the same numbers over and over. You already know what your max loss is, or the money that you're willing to risk, and you'll find that you usually risk the same amount of cents. I usually only risk 10 or 20 cents depending on the volatility of the stock. So I know I will always be using 1,000 shares if I'm risking 10 cents, or 500 shares if I'm risking 20 cents. Now, I want to go back to this 4-step process right here. When I started out trading, I did the exact opposite of this 4-step list, and I see a lot of other traders do it too. They would first determine their share size and then enter into the trade at the price they wanted. Then once they are in the trade, they determine their stop price, at which is some random number of cents at risk. This is going to make your stop loss on the trade some unknown number, which could be much bigger than you anticipated. Doing this will cause you to likely hesitate on taking the loss if you were wrong in the trade, and this will increase risk and also mess up your risk-to-reward ratio system. Here's an example of managing your risk using a chart pattern. This is going to be a strategy that I teach you coming up, so I'm not going to get into the details of it, but let's just say that we're looking at this chart pattern and we only see what's highlighted in this blue area. Everything in this dark gray is something in the future. We can't tell what it's going to do. It hasn't happened yet. So we're just looking at this pattern right here. So we're looking at the stock, it's breaking through this 350 resistance area, and then it's coming back down to test that resistance as support now. So we're eyeballing the stock and we say, hey, I want to buy this if the support level holds. So how would we determine our risk getting ready to take the trade? Well, first, we already know what the amount we're willing to risk. We want to risk $100. And then the second thing we know is, where's our stop going to be? Our stop is going to be below the support. So we are waiting for confirmation that this previous resistance is going to hold as support, and we get that confirmation by getting these 3 candles, 1, 2, 3, not breaking down below 350. So we say, okay, this 350 level is holding. We're going to put our stop just below 350. So we'll put our stop at 349. You should probably maybe put it at 340 just to give it a little bit more room, but in this example, we're going to put it at 349. So as this is pulling back down, we need to constantly be thinking where our entry price most likely will be. Do we want our entry price to be 10 cents above 349 or 20 cents above 349? Where is our cents at risk most likely going to be in terms of the difference of our stop and our entry? So we're going to determine that our entry price is most likely going to be at 369. This is going to be 20 cents. We need to determine our share size before we jump into the stock. And to do that, we have to do a little bit of math. If we're risking $100, what's the difference between our stop and our entry? It's 20 cents. We're most likely going to get this at 369. Our stop is predetermined at 349. That's a difference of 20 cents. So we take the dollars we're willing to risk, divide that by 20 cents. This is going to be 500 shares. So we're going to take this trade, 500 shares at $3.69 with a target of $4.09, because that will be double the difference between our entry and our stop, giving us a 1-to-2 risk-to-reward ratio. So we talked about managing risk for losing trades, but we also need to manage our risk from losing profits on our winning trades. It's common to hold on to a winning position only to see your winning position turn into a losing position just because you didn't sell. You have to realize that the market is unpredictable and that you can't know for sure how far a stock will move in your favor. But at the same time, we can't cap our winners short in fear of giving back our profits because we need to at least obtain a risk reward ratio of 1-to-1. The best way to do this is to scale out of winning trades with predefined profit targets. By doing this, we are locking in profits as the stock is moving up and at the same time holding on to some shares for the potential big moves. Once I'm in a trade, I know exactly where I'm going to start selling my position. I like to sell at possible resistance areas, and I'll sell in half sizes. So, for example, if I took a 1,000 share position and it rises to my first profit target, I'll sell 500 shares and then change my stop price to the price I originally bought in at, which would keep me at break even for the remaining of the shares. I'll keep selling half of my position at possible resistance areas on the daily chart while also raising my stop loss for the remaining shares if the stock continues up. So by doing this, I'm giving myself a chance for the remaining shares to keep rising for bigger profits while also maintaining zero amount of risk. This is when I'm in the driver's seat and I'll make money on the trade no matter what. Here's an example of how I would scale out of a trade. Looking at a similar setup as we saw before, we get the break above resistance and we're looking for it to test as support. It holds as support as we see on these two candles and we enter on the first candle to make a new high. So $7.40 would be our entry price. Our stop would be just below the support, so we'll call it $7.20. That's a 20-cent stop. If we're risking $100, then we'll take it for 500 shares. So we let the trade work out, and our first profit target is at the next daily resistance level, which is $7.88. We wait for the stock to come up near that level and sell half our position. So we'll sell 250 shares, and once we sell that, we immediately adjust our stop to our entry price back here at $7.40. This gives us money on the trade no matter what the stock does afterwards, because we've already locked in half the position, we already locked in our profits, and the remaining of the shares are at break even. So by doing this, we're giving a chance for the stock to maybe try to break through 788 and continue higher where we can scale out even more. But in this case, it doesn't. It starts to fall back down right here, in which case I probably wouldn't let it get to my stop at break even. I would predict that this is going to be the top of this move right here because we get these big pullback candles right here and it breaks below the 9 moving average. So this is just a sign to say, hey, we're probably going to come back down and test this support. So there's no real reason to just let your stop get hit if it's unnecessary. But let's say that the stock did break through this 788. It breaks through the 788 and then curls back down to find some support at 788, just like the pattern back here. Once it did that, you would then adjust your stop to below 788. So you want to keep adjusting your stop below new market structures that the stock is making, such as support or swing highs and swing lows. Now, it's important to understand that not all the time is a stock going to make this move right here and then rise up to the next resistance where you can sell. Sometimes it'll make it just halfway and then fall back down. You're not always going to get a 1-to-2 risk-reward ratio, sometimes not even a 1-to-1, but as soon as the market gives you an exit indicator, such as it breaking down below a 9 moving average or breaking a new low off of a swing low pattern, then it's probably time to get out. That is risk management. I hope you can see how important it is to your trading, and if you just follow the risk-reward ratio system, trust in the system, know that you can take losers. Losers are not going to be a big deal as long as you try to make your winners bigger than your losers. So I hope you all learned something. Thank you so much for watching.